Hello everyone, and welcome to another live Q&A. This is October 11th of 2023. Today we're just going to go through a couple things that got sent to me, and as always, you guys can always say something live if you're here live, if you have any questions, and ask us anything. All right, without further ado, let's kind of go into basically the perfect predictor of the market right now. Right now, the basic perfect predictor is the reverse repo market. I can go in a little bit deeper into this. I know I've talked about this in the Adapt Advanced, and but let's kind of see what's going on here. Let's kind of try to make sense of this, right? So first, to make sense of what the reverse repo market is, let's kind of just crush that out of what it is, right? First is an account where banks can basically send cash to if they have too much cash reserves, right? It's like a parking spot for money, right? And when you give that to the Federal Reserve pays us a certain amount of money, or pays the bank a certain amount of money. So here, let me just pull up the reverse repo market really quick so we can go pull up the reverse repo market operations. And so this is coming from the Federal Reserve Bank of New York. And you can see here that they're offering 5.3% is what their rate is, right? Now, as I zoom out here, you can see that this got ballooned up, right? So I've talked about this before on a couple of my other Q&As, and I know I keep on getting questions about this, so we're just going to kind of dive through it. So as we accumulated in this account, basically what that was is there was so much cash in the system from when the Federal Reserve was printing quantitative easing. The banks had so much cash that they needed to park it somewhere, right? And yields were really garbage for treasuries. So, and the reverse repo market was offering just a little bit more yield, just a touch more yield than treasuries. And so it was natural for the banks to throw that extra cash in the reverse repo market. Now, once the printing stopped and basically the amount of money flowing into the banks basically stopped, the reverse repo market stopped growing because basically we didn't have growing excess cash in the banking system. Well, then inevitably you have two things that happen, right? One is you either have less amounts of cash in the banking system, and so that gets drained out. And so banks will need to pull it from somewhere, right? And they'd pull it from the reverse repo market or wherever, treasuries, things like that, right? So also what you can do, what's also happening is the fact that when the treasury market or the front end of the yield curve, right, basically kind of spikes up too much and goes too far above that 5.3 offering, it's natural for banks to take their money out of the reverse repo market and stick it into the treasury market to take advantage of those higher yields than what's offering here at the reverse repo market, right? And so it's kind of a buffer, right? It's kind of a ceiling for the bond market, right? And so that way, the Federal Reserve designed this to where we don't have too much spikes, right? This is kind of like this $3 trillion of buffer. Wasn't quite 3 trillion. It was, I think at its height, let's call it 2.3 trillion. Right now, we've taken this all the way down to 1.22. So we're about halfway drained out of the reverse repo market. And why is this a big deal? Well, let's come back over to the market. The reason why this is a big deal is because anytime there was parked cash in a account, say, think about like a piggy bank, right? And all of a sudden now yields have gotten attractive to where we're going to take that money out of that parking spot and put it into the bond market. When that starts to happen, that is new cash coming into the financial system that was parked at the Federal Reserve. In essence, think about this as like, this is quantitative easing. This is the Federal Reserve printing money into the financial system. But the thing is that they kind of already did it way back in the day. And they did it during the COVID era and, in preparation for basically this situation where we wouldn't have enough buyers for US debt at the current yield levels, right? And so this is a problem. And so what they did is they designed this system to basically use this $2.2 trillion to kind of ease the effect of this issue that we're running into right now. Now, it's kind of like a Band-Aid, right? It's a temporary solution to a long-term problem. And but let's talk about why this affects stocks primarily, right? As you can see here, when the reverse repo market drains, it's bullish for assets, and as it blows up, right, as it balloons up, it's bearish, and it's got this correlation. Well, what happened right here was we had a massive amount of draining out of the reverse repo market, and that's because the treasury yields were not high enough for investors. So then what happens is the reverse repo market comes in because the yield spiked up above what the reverse repo market is providing, and so it drains that account. New money coming into the system. Okay, now we go through here and we get our first little spat of no more new money coming into the system to stabilize the bond market. What does the stock market do? Boom, it drops. Why is this? Because there's no new money coming into the financial system. Remember, quantitative easing in its outright, right? If we go back to something like quantitative easing, so we show the Fed balance sheet. So if we show the Fed balance sheet back when the reverse repo market wasn't being used and it was just the Fed balance, or the Fed balance sheet was just growing because they were printing, right? What happens when the Federal Reserve starts printing money, right? Boom, stocks go up, right? What happens when the Federal Reserve stopped printing money? Boom, stocks corrected, right? Now, of course, then you look at 2013, what happens when the Federal Reserve prints money and pushes it into the bond market, right? They weren't buying stocks, they were buying bonds. But this in turn reduces risk premiums because it's new money coming into the system and it balloons stocks with it, right? And then of course, as soon as they stop, look, the market tries to correct and kind of teal off. And then eventually some growth kind of kicks in, and then we get, and this was also like a Trump era tax policies and everything that kind of pushed this up. And then of course you get quantitative tightening, which is removal of the system or removal of money in the system. And you get a much more choppy and chaotic and crazy market plus some tightening. Then of course, what happens? You start printing money again, stocks go up, right? Of course, you got a pandemic in here, and then they really printed money. So I digress. All we are is trying to see where's the money coming from. And as you can tell, right, as you can kind of think through this and we can look through the amount of money, there's a lot more money being drained out of the reverse repo market than what is, being tightened or being taken out of the Fed balance sheet, right? So even though the Fed balance sheet is going down and they're saying that they're quantitative tightening, this is a form of easing, actually, is what they're doing. And this is a very, very, very good predictor of the market behavior right now. As the market stalls in the reverse repo, or as the reverse repo market stalls and goes sideways, even for just a few days, or like a week in this case, right? You can see what happens, right? The instant the reverse repo market starts to climb up, boom, market starts to dive bomb, right? What happens the instant the reverse repo market starts to drain to new lows? Boom, market starts to go up again. It's just macroeconomics. You put new money in the system, you put money that wasn't in the financial system, and you get asset inflation, right? So hands down, this is what's going on. The reverse repo market is still draining. We did have an update today, but an update doesn't make a new cycle or something like that. We got to wait to kind of see where things go. And there is a little bit of lag between the reverse repo market and the stock market, which is really good because we actually kind of have a predictive value in this, right? As you can see here, we had the reverse repo market stall and start to climb up, and stocks didn't necessarily just instantly roll over. Yeah, they stopped going up, but they didn't just start dropping like a brick, right? The reverse repo market started to drain for a few days, right? But the market didn't start to go up yet. Boom, we start to go up, right? And then of course, there's not enough new money coming into the system to satiate the amount of buying that needs to happen in order to counteract the selling pressure that's out there, right? So even though we had this massive draining in the reverse repo, you really couldn't push up into the up into the stratosphere like what we were able to back here. So keep that in mind, that this is kind of how this is going to play out, right? And so even though we've got a pretty solid drain down here, it's very likely that this is not going to be able to continue going higher, much like what we had back here, right? Okie doke. On to some of the other questions. So there was a question that gets submitted to me quite often, and it's about the subjectivity of some of the strategies I run. So as you guys know, or maybe if you don't know, I run environmentaltradingedge.com or etradingedge.com for short. And we do SPX based options. And then, of course, I've got some macro portfolios as well. So going to this, there's a lot of questions about, well, I run into these strategies that are very subjective, and that, you kind of have to hold your mouth just right and like make sure you enter at like these, kind of rough areas. And, and if you start having problems, it's most likely, you're doing the system wrong, right? I get a lot of this, and they're like, well, I've tried these systems, I've tried this and that, and it just doesn't work, right? It's garbage. And I completely agree, right? If you're trying to follow along, if I were to be trying to follow along with a system, which I've done this before, because remember, I came from retail, I came from trading Joe Schmo, right? Just right out of college. I was, I owned a couple automotive shops. That's where I started out, right? I didn't start out in finance. And so what I learned, and what I had is basically the same thing as all you guys, right? It was basically a situation in which we try to follow someone else's system, but yet those systems have very like loose guidelines, right? Like, oh, make sure you kind of, I felt like the market was going this way this day, so I put on a little bit more extra negative delta, or I needed some structures here or there or something like that. And it's like, those are very difficult to follow unless you've got a very systematic way of dealing with that subjectivity that should be, somehow quantified, right? And so like for example, my adapt advance is a lot more, kind of fluid as far as that's concerned. Now the adapt dailies and the adapt intraday, or the awake portfolio or the sleep well portfolio, none of those have any kind of subjectivity to them. They have very hard set rules, like, no, we can enter at this, we're going to enter at these strikes, we're going to enter, when the market's at here, this is how you do things, right? And we don't do any adjustments, right? So that's a big question I get all the time, is about adjustments. And so no, there are no adjustments in any of the systems, except for the adapt advanced. And by the time you're looking at doing adjustments to anything, you're starting at advanced level. And so we can deal with that into going into the adapt advanced. Of course, you have to talk to me first. We have to kind of interview you and see and make sure that you're a good candidate for the adapt advanced, because it doesn't fit everyone, right? It's not meant for everyone, right? You do really need to have a very advanced knowledge of certain options, structures, how to execute things, and really risk management, and be consistent with certain things. But those are things that we talk about in the interview. But as far as my daily adapt and the adapt intraday, man, those are all for it. You can sign up anytime and test it out. They're not very much money for the amount of money you make with the systems itself, right? And so you can see that in the forums if you're part of the services already. I do always appreciate the comments that everyone says. I'm really glad that it works for so many people. So that's part of what I wanted to kind of crush out today, as far as macroeconomics reverse repo facility. And then I wanted to knock out the questions about the strategies. Another one that I get asked pretty regularly on the adapt intraday is how to exit, right? So I'm going to crush through the how to exit one more time, or I'll probably just continuously do this throughout the years. But the point is whenever we're exiting the adapt intraday, and if you're part of the service, you'll kind of understand this a lot more. But we want to let it get above our profit or loss target, right? Above or below, right? Depending on which side we're on. And we want to give it some time. So there's some issues with intraday options. And if you're a trader of intraday options, or you've done this for a while, or just options in general, you know that the market can quote some pretty erroneous prices. Also, you know that the market doesn't necessarily stay where it is, right? It's always fluctuating, it's always moving, it's always ticking up or down, right? And so if we let even something like a chart here, and let's just go into, let's turn this into like a candle chart. We'll go to, uh, and we're just on the SPX, perfect. And then let's just go to a candles. All right, and then let's go to, a 1 minute chart on here. So as you can see here, right, we're sitting there looking at a 1 minute chart, and this fluctuates, right? So let's just say that we have, I mean, this was a winning day today, but let's just kind of talk about, let's say that we have our limit like put somewhere right here for like a loss limit, right? And what'll happen is and this isn't like we don't have it in a line in the sand as far as like this is our price target. What happens is our structure will get fluctuated above or below that profit and loss target, and these little wicks will kind of tag you. But then overall, on average, you're actually very much above the limit, right? Yes, we've got a couple, bars or wicks that we're staying down, but over a certain period of time, we've actually are staying to where we're not exited, right? And so the way to fix that is you use some sort of like rolling average. I've got a tool that I use personally that I just built into Excel. I am working on getting that tool to where basically like a member could use it. The challenge is that of course I need to simplify it a little bit more so that it's not as complicated. Because of course with any type of software or tool or something like that, what ends up happening is there's so many questions about it that there ends up being more of like an IT type of situation where I'm always trying to fix the tool instead of the trading system. So anyways, just know that that's kind of like a whole nother ball of yarn. So I'm trying to simplify it as much as possible to where it's basically foolproof, to where we can basically just hit it and things make a lot of sense, and you can go from there. So anyway, so this tool basically what it does is it just takes in quotes, right? It uses an RTD function, pulling in quotes from say Thinkorswim. If you're using Thinkorswim, you can use another platform. But as far as this tool is concerned, it's Thinkorswim. And so as it comes through, it's just basically averaging all those quotes. And as those quotes get averaged out, it basically tells you, are you above or below your profit and loss target, right? And your loss target is set to a certain point that day. As it does that, you'll let you know. But then what ends up happening is you'll see the actual quote of the spread be far above your win target per se, if you're going for a win that day, right? And you kind of have to hold on and let it kind of play out, and then you take it late. Now this can show all sorts of different things, right? Because it creates its own dilemmas. It can create a dilemma where the market goes up and the average is now over, but yet the spread is now underneath your profit and loss target. Still, we take it, right? It's fine because the average went over our profit and loss target, right? It can also create a situation where, say, you're taking a loss that day, which happens, right? No strategy is perfect. Now your loss is far beyond what we were, trying to aim for, trying to stay close to the loss limit as, and now you had a massive, let's say we had like a 25% loss target, and now we're at like a 35 or a 38. Totally normal, right? It's actually how the system was developed anyways to have those systems or to have those types of losses built in there. So it's no big deal, right? But also the gains go the other way as well. So we get these big, huge wins, right? And that's very common as well. Definitely, we typically exceed the wins by a couple percent most of the time, by letting them kind of just breathe a little bit more. So that's something to take in mind. So I want to clarify that that's how we take our wins and losses. And let's see, the other point that I had in there, or the other question that I had in there, was something about the dailies, right? As some of you guys know, I use standard deviation calculations or standard deviation areas to size some of my spreads. If you're doing that in O&E specifically, right? TOS does not have this issue, but if you're doing that in O&E specifically, then watch out with the standard deviation level, right? I can pull up O&E really quick. You guys over there, I can share my screen over there. One second here. It's going to be, I don't have my toss open right now, so it's going to freak out most likely. Yeah, there it goes. So let me get this over onto, I can just go back and back test it really quick, and we can go a couple days in the back, and you guys will most likely see some sort of random thing up here. Yeah, number 11, some random thing I had on here. All right, so basically the point is, if I go to, and this is only live, right? Backtest doesn't have this issue at all. But basically, if you're looking for this one standard deviation mark down here and you're looking for where that is, right? What ends up happening is live, that'll, sit at a certain spot, right? But it sometimes is very wrong, right? It's not at the right spot. It's much wider than it's supposed to be, or it's shorter. Most of the time, what I've seen is it's a lot wider than it's supposed to be. If we go right up here to the configuration tab up here, and then we just click on this volatility surface, right, which is a different volatility modeling for our T+0 line, and then we uncheck it, right? If we uncheck it, then it will kind of snap those standard deviations back into place where they're supposed to be. So keep in mind that that is something that shows up in O&E and only in O&E. It does not have an issue with how we calculate it in TOS. Of course, if you're part of the systems, you know how I do that. All right, I think that crushes through pretty much all the questions that were sent to me. I think they were all fantastic questions. If I didn't see anything come in today with everyone that was here, so that means that that is pretty much set. And I'll see you guys next week around the same time. Like I said, I try to make it around 2 o'clock every Wednesday. Sometimes I have some meetings that run late, things like that, and I can't make it. But other than that, I'll see you guys next week. All right, bye guys.